Let's turn to the bond markets now and get a check on how they've performed overnight, what's in store today. And joining us is Simon Michell from FIIG Securities now. Simon, thank you so much for your time. Yeah, just firstly, give us a wrap. How did the bond markets fare? I mean, we're seeing a very flat read, obviously, in the equities. How are those bond markets looking?
Yeah, look, we saw a bit of a reversal of trend over in the US overnight. Some weaker jobs data came through, didn't quite meet expectations. And we saw yields actually kick up, which is from a low back in November level. So that was a bit of a reversal of trend where we've seen yields falling over the last couple of months. 10-year yields up a couple of points.
And what does that mean? What do you expect for the Australian bond market today?
Well, I suppose Australian bond yields have moved higher over the past couple of days in reaction to the RBA's announcement to maintain rates, official cash rate at 2.5% on Tuesday, as well as their view that we're entering a period of interest rate stability. So people are discounting the chance of another rate cut, and they'll be keeping an eye on weaker employment growth and also that higher inflation that was mentioned in the RBA's statement on Tuesday.
And I mean, you know, since that statement from the RBA, there, of course, we're waiting for a further statement from the RBA tomorrow, perhaps some sense that there might be a revising of growth, inflation forecasts there. But I mean, in terms of what investors have been doing, what have your clients been doing ever since that statement?
Yeah, look, I suppose the search continues for yield. We're seeing an increasing demand for inflation-linked bonds, inflation annuity bonds. So people are looking for an inflation hedge. You know, if inflation drifts up towards the higher end of the RBA target band, around that 3%, that starts to really impact on your term deposit returns. So people are looking to try and minimise the impact of that higher inflation.
Do you get the sense that there's still a lot of uncertainty there? There seemed to be a bit of calming perhaps overnight in markets, it seemed. But, I mean, do you get the sense that overall, though, really this year is going to be about uncertainty, about volatility?
Look, it is. I think a couple of things to focus on. Obviously, the US has the balancing act of this tapering of their stimulus program, and they're going to have to monitor how that impacts on growth levels over there. Domestically in Australia, obviously, we've got the situation where we've got inflation moving high would generally lead to higher interest rates, but you've got that weaker employment and wages data. So, you know, there's a really a fine balancing act on behalf of the central banks, both here in Australia and in the US this year.
You were talking there earlier about Australian investors looking to sort of lock in inflation protection. What are your recommendations on that? What are you looking at, and how much of your fixed income portfolio should that be?
Look, you know, we're certainly pushing a good allocation, probably about a third into inflation protection at the moment. Pure inflation hedge is obviously an inflation-linked bond. If you can lock in a real return above inflation of 3-4%, you know, if inflation gets up to that 3% level, the upper end of the RBA band, you're now earning around 6-7%. That's attractive to investors. Also, inflation annuity bonds. So this is an ability to lock in a quarterly income stream that is also indexed to inflation. So it just completely lowers the impact of inflation on your spending power.
All right. Simon Michell, really appreciate your time. Thank you so much.
Good morning.
Simon Michell there, Director of Fixed Income Sales.